Hey, kamusta? How is your business or school studies? By the way, thank you for your time and visit. Are you working on an assignment? Preparing for a recitation? Reviewing for an examination? Or advancing a lesson? Learn the concept of debit and credit journalizing and posting entries of business transactions for your school or business. This video about the double entry accounting system is right for you. This is the fourth lesson and is part of a series of video lessons to help you master the fundamentals of accounting. Ready to focus on our topic? The purpose of accounting is to generate business financial information and communicate it for decision making. But how is financial information created to become useful? Well, the procedure is called the accounting process. That is right. Just like before a mobile phone or a pair of shoes ever become useful products, they must first be processed. They could not come into existence by themselves, they all went through manufacturing processes. Now, for accounting. The procedures, or initial steps for converting or transforming financial data into useful financial information, is called accounting process. It consists of different stages. The first two stages, which we will take up here, are the journalizing and posting. Let us look at the first stage, which is journalizing, or the recording of raw business transactions into the journal book. The recordings in this step is normally unorganized. Take a look at the sample journal record. What did you notice? For example, on cash account, did you observe that it is mixed up with all other accounts in that journal page? That is the case on all pages of the journal book. So, if you have 100 pages of these journal entries, with mixtures of different accounts, it won't be very easy to quickly determine how much is the total for cash, or the total of sales, and so on for the other accounts. To arrange or organize the accounts, we need the next stage, which is posting. This process is where journal recordings are organized by accounts, by grouping similar accounts into the ledger book. Example, all cash transactions are transferred all together into the ledger page for cash. By doing that, the cash account can now be totaled, and by classifying all the other accounts, we can now extract all of the total balances. Excited to do and learn journalizing and posting? Well, we're getting closer if you are ready. To record financial transactions, we will employ the services of an accounting tool or device, which is called account title or account name. Account titles will be the ones responsible in holding daily transactions. As a storage device, its function is to accept the monetary increase or decrease in values as a result of business transactions. We are all excited. In a moment, we will be working on journal entries. But before we do that, let us recap a few more basic differences between a journal book and a ledger book. The journal book is where we first record a transaction, and each is arranged according to the dates each is transacted. Afterwards, each is transferred to the ledger book. In order to balance the equation, we must apply the double entry procedure, also called debit and credit entries. Back in the previous lessons, we have been exposing the double entry concept, and by this time, our knowledge has become stronger. The journal entries, as we have seen earlier, are unorganized, or unclassified, or ungrouped. But once the entries are migrated into the ledger book according to their types or classes, we start to have an organized accounts, with their total balances ready to be extracted and used. With that as background, let us proceed to the main objective in this lesson, which is to illustrate the concept and techniques of journalizing and posting. As provided on the screen, what you see is a sample case illustration covering 1-month transaction for a service business. Dear folks, in recording these business transactions, we must understand the two sides of an account title. One side is the increase side, and the other side is the decrease side. Depending on the category of accounts, each account title has its own side of increase and own side of decrease. Remember this, not all accounts have the same rules, meaning, the increase side of a particular account may not be the same increase side as compared to another account. But there is good news. There are only 6 categories of accounts, 3 of which share the same rules, and the other 3 also share the same but opposite rules. Check this out. By properly applying the simple rules of increase and decrease logic, and recording all these transactions using a bookkeeping procedure called double entry accounting method, we will eventually create an equal balance in the accounting equation like this. To demonstrate the simple rules of recording a transaction, let us upload the page of a journal book. That is a journal page. All monetary values are written on the two sides. The two sides are the left side and the right side. Is it correct to right away call the left side the increase side? Or the right side the decrease side? The answer is no, because not all accounts have the same side of increase and decrease. The good thing is, three of the major accounts, namely, assets, expenses, and drawings, have the same increase and decrease side. That should make things easier now, because all the account titles under them will have the same sides of increase and the same side of decrease. Let us now officially designate the increase side of these three elements as left side and the decrease side as right side. Now, for the other three accounting elements, namely, liabilities, capital, and revenues, we will simply reverse the rules. That is right. The rule is simply the opposite. Therefore, the increase side of all account titles belonging to these three elements will be right side, and the decrease side will be left side. One more time. Let us recap the summary of rules for recording on the left side, and for recording on the right side. First, whenever assets, expenses, and drawings are increasing, the amounts of increase are plotted on the left side, and whenever they are decreasing, the amounts of decrease are plotted on the right side. Second, whenever liabilities, capital, and revenues are increasing, the amounts of increase are plotted on the right side, and whenever decreasing, the amounts of decrease are plotted on the left side. Having identified the increase and decrease side of the accounts, let us also identify their normal balances side. What is a normal balance side? Well, it is simply the positive side, or the increase side of an account. Therefore, the normal balance side of assets, expenses, and drawings is the left side or debit side, and the normal balance side of liabilities, capital, and revenues is the right side or credit side. Congratulations! We have just learned the debit and credit rules, or the increase and decrease entry rules on accounts. One of the reasons you may not be able to plot these journalizing rules correctly is when you are not familiar with the various account titles. Go back to Lesson 2 and review the classifications of accounts. Let us now start journalizing the business transactions of Taft Avenue Service Center on March 1. Analyzing this transaction, there are three accounts which are affected. First is the cash account, because cash is being placed into the business. The second one is a loans payable account, because cash was borrowed from a bank for the business, and the third one is the owner's capital account, because the owner directly invested its own cash into the business. Now for the journal entries, the total amount of cash entering the business of Mr. Taft is $150,000, consisting of his own investment amounting to $100,000 plus the $50,000 borrowed from a bank, which the statement says is included in the $150,000. Therefore, for the debit or left side entry, the asset account cash will be increased by the total amount of $150,000. On the other money column, or credit right side entry, the loans payable account will be increased by $50,000, and also on the same money column, the equity account, Taft Capital, also increased by $100,000. A short explanation may help you remember what the transaction is all about. Before we proceed to the March 2nd transaction, let us strengthen our journalizing skills by making sure that we are familiar with the requirements of the double entry method and correctly follow its concept. The double entry system is the one responsible for the equality of the accounting equation. It simply tells us that, first, for each transaction, at least 2 accounts are affected. It could be more than 2, but it should never be just one account. The plotting of accounts must be on both sides, and not just on a single side. Second, the left and right sides must have equal amounts or totals after each transaction has been journalized. That's it. That is the double entry accounting system. Make sure to follow it along with the increase and decrease rules. Now let us analyze transaction on March 2nd. Shop equipment account is an asset account. It is being purchased for the business for a total cost of $60,000. Therefore, this particular asset account is increasing. The rule says, whenever an asset is increasing, it is to be plotted in the debit or left side. So, let's simply follow the rule and plot the entry. A cash of $40,000 is being used to pay it partially. Cash is being used for payment. The rule says, whenever an asset is being decreased, the decrease in amount should be plotted on the credit or right side. Let us simply follow that rule and decrease cash by $40,000 and plotting the amount on the right side. The right side is still lacking by $20,000. Do not proceed to the next date until both sides are equal. For the difference of $20,000, it is being paid as well, but using personal cash of Mr. Taft through his personal credit card. Whenever personal asset is being used for the business, it is treated as an investment. Therefore, the account Taft capital will increase by $20,000. Let us make a brief review. On March 1, cash is plotted on the debit because it is increasing, and rule says, when an asset is increasing, simply plot it on the left or debit side. Next on March 2, cash is plotted on the right side because it is decreasing. The rule says, when an asset is decreasing, simply write the amount on the left or credit side. If you're still a little bit confused, go back the kindergarten rules that we just listed and you will realize how easy this is. Before we jump into March 3, let us identify the parts of the journal page which we have been working on. Let us start with the date column. Dates are arranged chronologically, or according to the sequence of dates that each transaction is transacted on. There is no need to rewrite the month of transaction date for every transaction. On the succeeding transaction after the first transaction of the month, simply write the date number, and that's it. Following the date column, is the transactions or the particulars column. This is where we write the account titles affected by each transaction. Always start with the accounts to be debited first, and then followed by the accounts to be credited. All credits should be indented by, at least, 5 character spaces. The credits may be followed by a brief description regarding the transaction. Do not forget to observe or provide a single space after every transaction. Next, is the ledger book reference column. This is where you write the ledger page where the journal entry has been transferred, or posted in the ledger book. This will make it easy to trace, or verify records, from and to the journal and ledger books. After the folio, is the columns for the currency symbols. Whether it is peso, dollars, dinar, reals, rupee, etc., this is where to write the currency symbol. It is written just once on the first journal entry. There is no need to repeat the currency symbol for every transaction. Lastly is the left side and right side columns, technically known as debit and credit columns. The money columns are arranged to contain tenths, hundreds, thousands, and millions. The small section is for centavos. When writing the whole values and centavos, there is no need to use a comma and/or decimal point. Do you like what you are learning here? Learning Spaces would like to say, thank you for being a subscriber on this learning community. Welcome to Learning Spaces community. Continuing on our transaction on March 3, a 1-year rental has been paid in advance. This is an example of future expenses paid ahead before actual incurrence of the expense. Therefore, we need to increase an asset account called prepaid rent by $24,000. On the other side, since cash was used for the future rental payments, we shall decrease the cash account by the same amount. This is an example of an asset being converted into another asset. Since the amounts on both sides are the same, there should be no change in the accounting equation. Also, always remember, whenever expenses are paid in advance, or it is intended for future use, the word prepaid is used to designate the amount as still an asset. Moving to March 4 transaction. The renovation cost should be recorded as repairs and maintenance expense for $14,000. Kindly remember, whenever expenses are incurred, used, or expired, they are increased on their normal side, which is debit left side. And for the credit right side, since the expenditure was paid in cash, we shall plot the decrease in the cash account by the same amount. Now, compared to March 3, we did not use the word prepaid for this expenditure because it was not stated that it is an advance payment for future expenses. Going down to the transaction on March 5, for the expenses paid for business registration, the expense account will be permit and licenses expense. An increase amounting to $1,500 should be plotted on its normal balance side. Since the registration expenses were paid on cash, we shall decrease cash and plot the amount of $1,500 on the credit right side. Are you getting the logic and procedures so far? Simply rewind the lesson in case you're lost somewhere. Moving farther down to March 6, the purchase of shop supplies will increase the asset account shop supplies by $1,000. Again, whenever an asset is increasing, plot it on the debit or left side. On the credit side, we plot $1,000. That is, to increase the accounts payable, because the statement says, on account, which means, not yet paid or to be paid in the future. Progressing into the March 7 transaction, there are two accounts affected by this transaction. One is an asset, and the other one is a revenue. The collection of $13,500 cash from a client will increase the cash account by that amount. Applying the rule on assets, the increase is then plotted on the normal increase side, which is debit or left side. For the other side, a revenue account called service income is increased, also by $13,500. The accounting rule is very basic. Whenever a revenue account is increasing, plot the amount on the credit or right side. Crossing down to the transaction on March 8, two kinds of expenses were paid on this date, namely, utilities expense and salaries expense. Expenses have a normal side of debit or left side. Therefore, let us plot the increase in both expenses, amounting to $500 and $1,200, respectively. Both expenses were paid in cash, and to decrease that asset account, we plot the amount of decrease on the credit side to affect the decrease on the cash account by the total of the two expenses, amounting to $1,700. Marching forward to March 9 event, the service center billed a client, meaning, there has been no payment received yet, so, a notice of demand, or known as a bill, is sent to the client, advising the client to settle the amount. This is called accounts receivable, which is an asset account. This asset account is increased on the debit side by $12,000 worth of services already provided to the client. To match the debit entry, we need to plot an equal increase in a revenue account, called service income, for the same amount of $12,000 on its credit increase side. Hooray! What a beautiful day! Keep learning every day. Before we proceed to March 10, it is timely to discover the two types of journal entries. The first type is called a simple journal entry, which means one debit entry and one credit entry. The March 9 journal entry is an example of a simple journal entry. The second type is called a compound journal entry, which means 3 or more accounts in the journal entry. The March 8 journal entry is an example of a compound journal entry. Charging onwards to March 10 business transaction. A cash is received for future services. Obviously then, cash account will increase by $30,000 on its increase side of debit, or left side. But since the cash received is for an advance collection for future services, This will not be treated as an income yet. At the moment, it will be treated as a liability and will be stored in a liability account title called Unearned Service Income amounting to $30,000. Did you see the difference between March 9 versus March 10? In March 9, the service is already rendered or completed. That is why it is recognized as a service income. While in March 10, the service is still to be rendered and not yet completed. Therefore, while cash is already received and recorded, a counter liability is recognized via the account title Unearned Service Income. The March 11 transaction is related to the March 9 transaction. The statement says, it collected 50% of the $12,000 accounts receivable on that date. Therefore, as a result of partial collection, the cash account will increase by 50% of that amount, or $6,000 on the debit side. Further, the statement says that the remaining 50% is now being transferred to a promissory note. Therefore, the note's receivable asset account shall also increase by $6,000, also on the debit side. Matching the two debit entries, the accounts receivable previously debited on March 9 will now be cancelled by decreasing it on the credit side, amounting to $12,000, which is the total of the two debits. Moving now to March 12, the purchase of Toyota van will increase an asset account called Transportation Equipment for a total purchase cost amounting to $30,000 on the debit side. The statement clearly says, on account, or is not yet paid. Therefore, on the credit side, we shall recognize a liability, in the form of accounts payable, amounting to the same amount of $30,000. Analyzing March 13 transaction, the statement did not say whether the equipment was paid in cash or on account. If there are no wordings about being on account, treat it as cash payment. Therefore, we shall debit office equipment for $7,500 and credit cash for the same amount of $7,500. Which of these three transaction dates do you think would not affect the accounting equation? Is it March 11th, or March 12th, or March 13th? Which ones? By now, you should be confident with your answers. Let us leave that for you to answer. Alright, moving on. Let's develop more entries, this time on transaction date, March 14. On March 14, the loan from the bank on March 1 is partially being paid. In this case, we should decrease the loan's payable account by the principal payment of $5,000 as stated by the statement. The amount is now plotted on the decrease side of a liability, which is debit, or left side. One more entry on the debit side, this time, regarding the interest expense incurred on the loan. The increase in interest expense is plotted on the debit, or left side. After completing the two debit entries, let us also settle the required entry on the credit, or right side. To balance both sides, we need to plot the total cash payment of $5,100, consisting of the principal loan amount and the interest amount incurred on the loan. If you have been monitoring the accounting equation below, you would notice that all expenses incurred, or used, are being deducted on the capital, and all revenues already earned are being added to it. If you are wondering why, or what other items are affecting the capital, go back and review Lesson 3 about Transactional Analysis and Accounting Equation. Midway through March 15 transaction, the transfer of personal or home equipment for business use will increase the asset account, office equipment, by $2,000, and that is plotted on the debit, which is the normal increase side of all assets. On the other hand, the capital of Mr. Taft should also increase by $2,000 as a result of converting his home equipment into office use. The accounting equation in this case will increase total assets and total capital, each by $2,000. On March 16, the purchase of supplies will increase the asset account, office supplies, by $1,000, which is plotted on the debit side. Again, this is assumed to have been paid in cash, which shall decrease the cash account by the same amount on the credit side. Down to the March 17 transaction, receiving income means a cash is received for the services already rendered. As a result, we shall increase the cash account by $35,000 on the debit side. And of course, on the credit side, since the income is already earned, meaning the services are already provided to the clients, we shall plot the same amount for service income account. Charging forward to transaction on March 18. An office supplies worth $200 is taken by Mr. Taft for his personal consumption. This case will decrease his capital, but we shall use the account, Taft, drawing, to record the decrease. The drawing account will eventually decrease the capital account. Let us now analyze transaction on March 19. When expenses are incurred, the expenses are increased on their normal side, which is debit. Let us assume the expenses are for salaries, $3,500, utilities expense, $1,000, and advertising expense, $500. All for a total of $5,000, which are all paid in cash. Therefore, on the credit side, we shall decrease the cash account by a total of $5,000. Looking now at March 20 transaction, wherein an additional investment is made by Mr. Taft on that date. A land he owned, and is valued at $100,000, is invested by him into his business. The asset account land is increased by that amount, which shall be plotted on the debit side. As per the information on that date, the entire amount of $100,000 will not be credited as Taft capital, because incidentally, the mortgage liability on the land, which is amounting to $50,000, is also being transferred by Mr. Taft into his business. In this scenario, we should now credit both mortgage payable by $50,000 and Taft capital for the remaining $50,000. Now, going down to March 21, where another payment on the loan in March 1 is again being made. The loans payable account will again decrease by $5,000 on its debit decrease side. Along with the partial loan settlement, and interest expense is also recorded on its debit increase side, amounting to $100. To complete the journal entry on that date, this time on the credit side, the payment of cash totaling $5,100 will now be plotted as a result of partially paying the loan on March 1, plus the interest due on it. Hey, keep doing great. Are you getting the simple logic of debit and credit? Or the so-called plus side and minus side of accounts? Nice and cool. Let's move closer to the finish line. Now this time on March 22, this transaction is related to the advance cash collection for services in March 10. Take a look. Remember that date? On that date, we credited a liability obligation of $30,000 to unearned service income. Then now, March 22, a portion of that, which is $4,000, has already been provided, and therefore, has already been earned. Let us now reduce the unearned service income by debiting it, amounting to $4,000, and simultaneously, let us also recognize on the credit side, the service income already earned for the same amount. Hooray! What a fantastic day! We are getting closer to accomplishing our journalizing skills. Let's bring in March 23 transaction. The business event on this date is about a service already provided but is not yet collected. Hence, we plot the accounts receivable account on its normal balance side of debit, in anticipation that the amount will be collected in the future. And, since it is about services, which have already been completed for a client, we likewise credit the account title, service income on its normal balance side, which is credit, for the same amount of $13,000. Forwarding to the transaction on March 24, the $4,000 various expenses incurred but not yet paid, are actually, for the utilities expense amounting to $2,000, and for taxes expense also amounting to $2,000, and which are both, to be plotted on their normal increase side of debit. And for the credit side, since the statement implied, that these expenses are not yet paid, then we cannot credit cash. Instead, we should credit the liability accounts for each, such as utilities payable, $2,000, and taxes payable, $2,000. Pushing forward to the transaction on March 25, where another purchase of equipment for office use was made, that will increase the asset account, office equipment, by $1,000, and is plotted on the increase side of assets, which is debit. The purchase was made on cash basis, therefore, the asset account cash will be decreased by $1,000, and is plotted on the decrease side of assets, which is credit. Marching on, with your help, let us analyze transaction occurring on March 26. Would you like to first do this yourself? Wanna try it? Pause this video and try to answer it now. This is already the third payment on the bank loan on March 1, pretty sure, you already know the entry. But, beware, because instead of the business cash, it is the personal cash of the owner that has been used to settle it. Go ahead, pause this video and try it yourself. Alright, here is the journal entry. There are two debits, the cancellation of loans payable amounting to $5,000, and the recognition of interest expense, amounting to $100. On the credit, instead of crediting cash, we instead credit Taft Capital for the amount of $5,100, because it is the cash of the owner that was used to settle the partial payment of loan plus the interest. Hooray! Wake up! Wake up! 3 more transactions and we are done. After plotting all the journal entries, our next step will be to post everything on the ledger pages. Are you excited for that? Here is the transaction on March 27. This transaction is somewhat opposite compared to the one we had on March 26, because this one, the owner personally collected the receivable of the business, and then, he uses it for home purposes. In cases like this, the drawing account should be debited for the amount drawn, which in this case, is $3,000. And for the credit, since the receivable, which was recorded on March 23, is already collected, it should be cancelled by crediting it amounting to $3,000. Are you keeping it up? We are now on the March 28 transaction. The sale of office equipment on that date, which is sold partially on cash and on account, will increase cash and accounts receivable accounts by $1,000 each, which are both on the debit side since they are both increasing. Then on the credit side, we plot the cancellation, or the decrease of the office equipment account, which is amounting to $2,000. Wow, what a great job! We are now down to the last 2 transactions. On March 29, the client on March 28, who owes the business on an account, issued a promissory notes in exchange for the open account. Therefore, we debit to increase the notes receivable for the $1,000. Then on the credit, we decrease the accounts receivable for the same amount in order to cancel it. Congratulations for reaching the last date for our case journal entries. The transaction on March 30 is about the payment of accrued liability expenses, which were incurred and recorded on March 24. We split the payment of $3,000 to the whole of $2,000 utilities payable, and the remaining $1,000 to the taxes payable. Both accounts are debited to decrease them. Both accrued liabilities were paid in cash on that date. Therefore, we decrease the cash account by crediting it, amounting to the total payment of $3,000. What a great accomplishment! We just finished journalizing the 1-month business financial transactions of Taft Avenue Service Center. Before we work on the ledger entries, also known as posting entries, let us again summarize the tips in journalizing. First, be familiar with the account titles and their classifications, whether they are assets, liabilities, capital, expenses, or revenues. Second, be familiar with the basic decrease side and increase side of account titles. Third, make sure to follow the double entry system, which demands that at least 2 accounts must be affected by each transaction, and the debit and credit sides must always equal after plotting each transaction. Fourth, always imagine or observe whether each journal entry is respecting the equality of the accounting equation. Once you are familiar with all of these details, journalizing will be perfectly basic and easy for you. Hooray! What an awesome day! After completing the journal entries into the journal pages, the next step is to post them in the ledger book. Here are samples of ledger pages containing each of the account titles. Folks, a ledger page, or a ledger book, just like the journal book has columns for dates, particulars, reference, debit and credit. But the difference this time is that there is an additional column, which is called the balance column. So, after each transaction is posted, a balance is immediately computed. The purpose of each ledger is to summarize the final balances of each account, so that a copy of a trial balance can be prepared. Like this one appearing on the screen. That is right. After we have completed the posting of journal entries, we will prepare a copy of a trial balance. Keep watching and learning. The process of posting is pretty basic, very easy, and straightforward. Simply transfer all debits and credit journal entries to the same debit and credit sides in their respective ledger pages. In addition, this time, we also compute for the balance of each account after each date is plotted. Let us start with March 1. Are you ready? Alright, coming up. Here we go. There are 3 accounts on this March 1 transaction. Let us first transfer the debit entry of cash, by writing it on the debit side of the ledger for cash, and then forward the amount to the balance column. For the description column, simply describe what this transaction is all about. A clue can be taken from the explanation, which we did in the journal entry on the same date. Did you see that? Pretty simple, isn't it? For the reference column, simply write the journal page number, and that's it. Well done. Let us also do the same for the credit entries. The credit entries of loans payable and Taft Capital are transferred to the credit column of their respective ledger pages. Did you observe that the 3 accounts in the journal entries on March 1 were each plotted to different ledger pages? That is right. Each account is going home to their respective ledger pages. Also, take a look that there is a caption, balance from previous. That means, you need to bring forward any balance, coming from another ledger page or another month. If in case there is. If there is none, then simply remove that caption. The process of posting is pretty basic, very easy, and straightforward. Simply transfer all debits and credit journal entries to the same debit and credit sides in their respective ledger pages. In addition, this time, we also compute for the balance of each account after each date is plotted. Let us start with March 1. Are you ready? Alright, coming up. Here we go. There are 3 accounts on this March 1 transaction. Let us first transfer the debit entry of cash, by writing it on the debit side of the ledger for cash, and then forward the amount to the balance column. For the description column, simply describe what this transaction is all about. A clue can be taken from the explanation, which we did in the journal entry on the same date. Did you see that? Pretty simple, isn't it? For the reference column, simply write the journal page number, and that's it. Well done. Let us also do the same for the credit entries. The credit entries of loans payable and Taft Capital are transferred to the credit column of their respective ledger pages. Did you observe that the 3 accounts in the journal entries on March 1 were each plotted to different ledger pages? That is right. Each account is going home to their respective ledger pages. Also, take a look that there is a caption, balance from previous. That means, you need to bring forward any balance, coming from another ledger page or another month. If in case there is. If there is none, then simply remove that caption. Posting the March 2 journal entries, there are 3 accounts involved. Always start with the debit first, which is the shop equipment. Then followed by the credits, which are the cash ledger account and Taft Capital ledger account. Let us for a moment zoom and focus our eyes on the cash ledger and take a closer look on certain increase and decrease rules. The rules on increase and decrease, known as debit and credit, are still the same, and should be applied strictly and consistently. Therefore, for asset accounts like cash, all postings on the debits are additions, and all postings on the credit are deductions, and the result, or the difference between the 2 sides, should be forwarded to the balance column. On March 1, for example, cash was increased by $150,000. Therefore, the balance on that date is $150,000. But on March 2, cash was decreased by $40,000. Therefore, the balance on that date is down to $110,000. Failure to properly observe the debit and credit rules in the posting of entries will ruin the accounting equation and the financial statements. Folks, posting is lots of fun. Simply keep transferring all the individual accounts, just make sure they land to where they should exactly belong in the ledger book. Also, make sure to properly compute for the correct balances at the end of each date. When working on a posting, do it one date at a time. Do not jump from one date to another, because you might miss an entry. Missing just a single entry, or placing an entry on the wrong side, or adding an entry, instead of deducting it, will give you the wrong balance. It will also help if you mark each entry that you have already transferred to the ledger book. That way, you make sure everything is posted. Dude, there are so many human mistakes that can occur when posting or transferring journal entries into the ledger book. If you commit so many errors, it will be hell difficult to get into the correct trial balance or correct financial statements. That is pretty awful and frustrating, especially if you are on an examination. Avoid making mistakes in both journalizing and posting. Keep learning this lesson to master the logic, procedures, methods, etc. The rule of increase and decrease, known as debit and credit, may be very basic, and it is true, it is really basic, but it can be confusing if you don't spend time to play with it. Dear friends, keep watching our lessons. In no time, you will be good at it. Through constant practice, you will be able to master it. Isn't that great? Believe in yourself, and believe in our learning modules. We have enough of it to help you master the foundation courses in accounting. Just like the journal book, a ledger book contains the chronological order of transactions arranged from the oldest date to the latest date. Look at the cash ledger. We started plotting the cash transaction since March 1. So far, we have filled it until March 8, and the balance of cash on that date is $82,300. Which is exactly the difference between the total of debits and the total of credits. We have just finished posting page 1 of the journal book. Once more, congratulations for learning this far. Continuing on page 2 this time. Let us keep plotting the journal entries into their respective ledger pages. While we continue plotting the contents of the journal pages into the ledger pages, it is worthwhile to let everyone know that both the journal book and the ledger book do not guarantee the correctness of amounts, or the correctness of entries, or the correctness of accounts, etc. Even if we have followed the debit and credit rules, or even if we have observed the double entry system, the resulting financial statements may still possibly contain errors. Even if the trial balance, which we shall be preparing later, is equal on both sides, there is no guarantee the amounts are correct. Even if the accounting equation is perfectly balanced, or equal, there is a tendency that it may still contain certain errors. The correctness of financial statements depends on our human ability to avoid errors. There are times that we are tired, or not feeling well, or are emotional, or are in a hurry, or rush mode. All of these may affect what we are trying to accomplish, which normally leads to certain unintentional errors. Would you like to know what are some of the possible errors? Errors that may lead to erroneous financial statements? In a moment, let us list down some of these. Alright, here are some of the reasons, or errors which may bring some of the journal or ledger records incorrect. Remember, if the records are incorrect, the financial statements are likewise will become incorrect. Reason number 1, you entered an amount in a wrong account, for example, into a wrong asset account. Say, instead of correctly placing the amount in the office supplies account, it was erroneously placed in the shop supplies account. With that kind of error, the total of assets will still be correct. The equation will still be good. The balance sheet will still be in good form. But the amounts in the specific accounts are wrong, meaning the office supplies amount is wrong, and the shop supplies amount is wrong. Another mistake is, when you debited the cash account, instead of the accounts receivable account. Both are asset accounts. Therefore, the total assets will still be correct. The balance sheet will still be in good form. But the cash account is wrong, and the accounts receivable account is wrong. Or you credited the wrong liability account. Say, instead of crediting salaries payable, the utilities payable was credited instead. Since both are liabilities, the total liability will still be correct. The balance sheet will be fine, but the individual liability accounts are incorrect. Another mistake that might occur is the incorrect posting of a wrong amount in the accounts. For example, the correct transaction amount is $100, but it was recorded as $1,000 to both the debit and the credit into the accounts affected. Here, the double entry system is followed correctly. The accounts recorded were the correct accounts. The accounting equation will be in the same totals, the balance sheet is in good form. But the amounts in the accounts affected are not the correct amounts. Or, an error that might happen is, when recording $1,100 instead of the correct amount of $1,010 to both accounts affected. As long as the amount is recorded to both of the accounts affected, this error will not immediately pop up and may remain unchecked for a while. Did you now get the point when we say, we cannot always guarantee the 100% correctness or accuracy of financial statements? Alright, great. Let's keep posting the rest of the journal entries. After we have completed the posting procedures, we shall prepare the trial balance. The trial balance is a mechanism to verify that the double entry has been followed, at least to the best of human ability. Congratulations, we have just successfully posted the journal entries for the month of March into the ledger book. Our next step is the extraction of the total summary balances of each of the accounts, and bringing each into an informal summary form called the trial balance. The trial balance is the basis for preparing the financial statements. It starts with the heading, consisting of the name of the business, and then the trial balance title, and the date covered by the balances of accounts. It also has two money column sections, which are arranged according to the normal debit and credit balances of accounts. Remember the term, normal balances. The final balances of each of the accounts should appear in their normal balance side or the increase side. Alright, let us now extract the final normal balances of each of the accounts, starting with the current assets. Folks, if a particular ledger account balance is zero, like in this case, observe that the utilities payable balance is zero. Therefore, there is no need to extract or transfer the zero balance into the trial balance summary. Let us continue extracting the rest of the accounts with positive balances. We are almost done. What a great accomplishment. Learning this far is really awesome, isn't it? Are you wondering how should the accounts be arranged? Here's how the accounts should be arranged in the trial balance. First, are the balance sheet accounts, starting with current assets, then followed by the long-term assets. After that, begin plotting the current liabilities, and then, long-term liabilities, which is then followed by the capital account and the drawing account. Once all the balance sheet accounts are extracted, move next to the income statement accounts, particularly starting with the revenue accounts, then followed lastly by the expense accounts. After all accounts with positive balances have been extracted and transferred into the trial balance, the total of debits and the total of credits are now computed. Of course, since we have recorded all the transactions under the concept of double entry bookkeeping, we should expect that the totals of debit should exactly equal the total of credits. Congratulations for that. Remember this, the trial balance is not an official accounting report. It is simply a draft or scratch work. Its objective is to verify, or check, whether the double entry system has been properly applied, whether the rules of debit and credit have been consistently followed in the journalizing and posting procedures. Once the equality of the trial balance has been proven, and once there are no adjustments needed, we may now prepare the financial statements based on it. The lesson that you have just learned is enough to get you a high score in your recitation, or quiz about debit and credit journalizing and posting business transactions, including preparing a trial balance. If you need more review materials on this topic to validate your knowledge and understanding, check the description field below, or join the membership and get review questionnaires related or specific to journalizing and posting. Once a member, you will have access to other questionnaires on various lessons as well. Continue learning, we have lots of free lessons to help you master the foundation of accounting. Thank you for learning with us and see you in another accounting course lesson. Also check the description field below for links on online materials, books, exam reviewers, quiz materials, and more. Palam sa inyo. Goodbye for now.